The Alpha Horizon. Thinking different. Acting aware.
Welcome to the latest edition of the Alpha Horizon podcast from Algebris Investments. My name is Douglas Branson, and I'm Head of Business Development at Algebris. I'm very pleased to be joined by Alberto Gallo, who is Head of Global Credit Strategies. Many of you will also be familiar with him from the Silver Bullet commentary that he and his team produce, and of course from previous podcasts. As we head towards the end of the first half of the year with the continued success of vaccine rollouts and the easing of lockdown restrictions, we are seeing much improved sentiment, strong macro data releases, and risk asset valuations at elevated levels. This being said, we have seen an increase in volatility, and while there are certainly reasons to be positive, from an investing perspective, it is important to establish the appropriate level of cautiousness going into the second half of the year. There has been talk of investor euphoria in markets, and with peak monetary and fiscal stimulus, inflation is at the forefront of the discussion. The Fed and the ECB are holding the line for now, and it is rational to expect that this could change in the second half of the year. With this in mind, Alberto is going to offer his thoughts on three main areas. Firstly, on inflation, and then secondly, the Goldilocks scenario of markets at record highs, and lastly, how the global credit opportunities strategy is positioned. So Alberto, thank you very much for your time.
Thanks, Doug. It's nice, as always, to be in the Alpha Horizon, and thanks everyone for listening.
In a meeting, you referred to the Faustian Pact currently being demonstrated in the global economy and markets. Can you please just expand on what you meant by this?
If we think about the evolution of the economy and the financial system since the Second World War, we see that governments, starting with the United States, have often used policies to boost consumption and growth in the near term at the expense of lack of investment in infrastructure, in education, and in productivity in the long term. This is a Faustian bargain between short-term growth and long-term productivity. And it is explained by the great rise in government and in private debt, this last one having outpaced the growth of GDP by 4 times since the 60s, going from 100% to over 400% of GDP across developed economies. Because every time a small bump in the business cycle, the threat of recession would also endanger the government in place, it was easier to implement let-them-eat credit policies to help people to buy a house, a car, tuition for university. Uncle Sam would lend you that money, and you might have to worry about paying it back later. These policies, these let-them-eat credit policies, became more popular since the 60s and 70s, the creation of Fannie Mae, Freddie Mac, and over time created a mountain of debt which would only be possible to carry over with lower and lower interest rates. Accompanying this growing private debt and government debt, there were lower interest rates from the central bank. The Federal Reserve, led by Greenspan and other central banks around the world, gradually left interest rates lower and lower. We fast forward to the crisis of 2008 and we realize that all this large amount of debt is not sustainable. Since 2009, central bankers engaged in the quantitative easing programs and non-standard monetary policy, buying directly treasuries, corporate debt, and in some cases even stocks. Today, we have an economy that's been on this QE anesthetic for a very long time, but we have learned that despite their giant efforts and despite growing their balance sheets by multiples of GDP in some cases, central banks have failed to generate inflation by themselves. There is a game changer, however. Governments for the first time have been looking at infrastructure and investment in productivity generating efforts, and that's led by the Biden administration and also by the European Union. So for the first time, we might have a chance to exit the Faustian bargain of high debt and short-term growth and focus on long-term growth.
Okay, thank you. Perhaps you could comment on the most recent US labour market data and what this means for the Fed, as well as ECB meeting in which policymakers chose not to signal when they might start reducing the stimulus program. Are markets really so fragile that changing tact now could turn euphoria into panic?
The recovery of the last decade was characterized by a very strong implementation of monetary policy, what we called quantitative easing or QE infinity. Central bankers bought assets in the attempt to boost asset prices and by that boosting consumption, generating a wealth effect and pushing consumers to spend more. This helped when in 2009 consumers were seeing house prices collapse, and it helped to reduce panic, to put a floor under the economy's trajectory. However, we've also learned that over time, the use of QE across developed countries generated an asset-rich and wage-poor recovery. In other words, it rewarded asset owners, it rewarded certain regions that were more linked to trading and financial assets, immediately linked to the central bank's actions. And this benefit didn't really get to the real economy. As a result, it boosted the level of inequality to 100-year highs. Wealth inequality in the United States, in the United Kingdom, is currently the same as it was in the 1920s. Voters picked policies and continue to choose policies that are now aimed at re-establishing a more even and inclusive growth level in the economy. The low level of interest rates that central bankers implemented in the past decade and before that also encouraged oligopolistic and monopolistic behavior across companies. This means that you tend to have the winner in certain sector buying all the potential competitors. But this winner-takes-all effect reduces competition and in turn, over time, also productivity. So today we have an attempt from governments to re-establish a more inclusive growth environment with the infrastructure spending plan in the US and the European Next Gen plan by the European Union. However, these plans are also likely to generate inflation, and commodity prices have already reached record highs across industrial metals and also oil. Now, producer price inflation is growing at 4 to 5% year on year since 2020, but it hasn't yet translated into consumer price inflation and wage inflation. This is the key development that we are watching, because as inflation starts getting close to central bank targets, it is possible that central bankers over the next months might have to taper their extraordinary QE programs implemented during the COVID recovery, and this could generate an amount of volatility in markets.
Understood, thank you. And with markets at record highs, are there any safe assets? And if so, what are they? And I suppose it's worth mentioning the point that there's been some debate about the traditional 60-40 portfolio. Is this type of portfolio fit for purpose in the current investing environment? And if not, what is?
One of the victims of the COVID crisis is certainly the risk-free rate. With central banks pushing interest rates to zero or negative territory and government spending on infrastructure and income support, interest rates are now, both in the short term of yield curves and in the long term of yield curves, well below inflation across all developed markets. This includes both risky bonds like BTPs in Italy or GGBs in Greece, as well as risk-free bonds like gilts in the UK or treasuries in the US. They all yield very much below inflation. So the real rate in the 10-year maturity today is between minus 0.3% if you're investing in BTPs in the Eurozone and close to minus 3% if you're investing in gilts in the UK, where inflation is much higher. This means that every year, in order to park your cash in a safe treasury bond, you're essentially giving a 1 to 3% tax against inflation. You're giving out part of your capital. Now, it might seem a small amount, but if you compound this over 5 to 10 years, you're essentially losing a quarter to a third of your capital. In other words, investors are pushed to take more risk. This is all good when risky assets are cheap. For example, 1 year ago, during the COVID crisis, we had moments of panic and we had very good entry points in a number of credit assets, which as investors, we also managed to buy. However, today, valuations across risky assets are much more expensive. This calls for caution, but it also calls for a rethink of the 60-40 balanced portfolio. The reason is that with only one game in town, with a decade of central banks buying assets, not only the risk-free rate has become very negative and the real rate has become even more negative against inflation, but assets have become a lot more correlated. This means that during sell-offs, when central banks withdraw stimulus, the so-called taper tantrums, both risky and risk-free assets move down in tandem. It happened last March in 2020, and it happened before in 2018 and in 2013. So there are moments where, for investors, there's essentially nowhere to hide. And rather than having a 60-40 stock bond portfolio, we prefer to have a barbell portfolio with a mix of risky assets and liquidity.
Right, and continuing to look forward, what would you say is the most important question for portfolio construction in the next 3 to 5 years?
One of the key assumptions underlying a lot of investment strategies today, bond strategies, balanced portfolios, multi-strategy portfolios, is that inflation will remain under control and markets will behave according to the guidance of central banks. We don't think there is a scenario where inflation goes out of control, but what if investors are wrong? What if inflation goes persistently a bit above target? What if the US jobs data starts improving later this year? What if central banks, for the first time, after working for decades on their own and calling for government spending, finally will start having the opposite problem that they had before? So too much spending and too much rise in wages. Even if this is not our base case scenario, we can say for sure that markets, given positioning data, are definitely not prepared for it. And therefore, even some persistent, some non-transitory rise in inflation might cause some shocks over time. Today, given the recent inflation data and the muted market reaction, we can say that interest rates and bond markets assume that central bankers are right, that inflation will be transitory, and that the tapering out of the extraordinary COVID stimulus will be orderly. However, there are signs that suggest that we might not really know whether inflation is temporary or not, and there are signs that suggest there might be some more persistent components of inflation. For example, in the United States, the red states, which have reopened earlier due to Republican policy, are the ones that are creating jobs more rapidly. There's also some signs of a mismatch in jobs between what companies are looking for and the skill set of workers, with the pre-COVID basket of goods being a bit different from the current post-COVID basket of consumption. There's also a number of workers that have gone out of the workforce for good, and this suggests that perhaps we might have a smaller pool of available workers. In other words, companies are struggling to find workers both in the US and also in the UK, even for relatively basic jobs. And this suggests that for the first time in a while, wages might start to rise. Another factor that suggests that inflation might be a little bit more persistent is politics. Let's remember that until now, the median voter in developed markets was a baby boomer who was much concerned about inflation, about asset growth and wealth. But going forward, the median voter will be a millennial. Millennials have been left out of the recovery and they're a lot more concerned about inequality and the redistribution of opportunity. If we think about the Biden policies that are being implemented, the potential taxation, higher tax rates for companies and for the top 1%, there is a long way to go for these policies, given tax rates are at record lows. This might mean more redistribution, but also more spending. As Milton Friedman once said, there's nothing more permanent than a temporary government program. For this reason, we think that government infrastructure investment and spending might be a little bit more long-standing than investors assume, and that therefore the level of inflation that currently is expected in the market might be a little bit optimistic. There is a chance, in other words, that governments might not be able to close the purse after it's opened.
Thank you. And then just one last question. How is your strategy currently positioned? And I suppose, how do you see this changing over the course of the rest of this year?
If you're doing income investing today, if you're looking for yield in the bond market, the opportunity set that you face looks a lot like picking pennies in front of a railway track. In other words, many of the opportunities that you see in the market give you 1% or 2% yield if everything goes well, but if there is a recession, if there is a crisis, they might lose 5 or 10%. In other words, you can lose several years of carry if things turn sour. What we try to do in our global credit strategies is exactly the opposite. We essentially try to rebalance the odds in the investor's favor, odds which have been skewed by many years of central banks buying of bond markets to pushing them to record low yields. How do we do this? Well, instead of having a portfolio that's fully invested, for example, in BBB bonds or in BTPs, which would give you very little leeway and room to buy assets in a crisis and relatively limited upside in a scenario of economic recovery, we use a barbell approach. This means that we hold a good amount of liquidity. In this case, more than a third of our portfolio is in liquid assets, which means that we can sell these assets and we can deploy the capital in case of a recession, giving us optionality. And on the other hand, we have selected credit opportunities with good yield of 4, 5, 6% and above, which still have upside to raise in price, to tighten in spreads, and in particular, a good portion of the portfolio is in convertible debt. Convertible bonds, which are currently out of the money, include an option on the underlying stock of the company. In particular, we are buyers of convertible debt in sectors linked to economic reopening. After a year in lockdown, many companies in the transportation, services, hotels, cruises sectors are still relatively cheap, especially outside of the United States. As global populations get vaccinated, these companies offer a good upside to a recovery and a reopening of the economy. And these bonds not only give you a relatively decent coupon, but also give the investor the option to have their capital grow as the economy reopens and prices of goods go up. Therefore, rather than having a fully invested portfolio in investment grade or high yield debt with relatively limited yield but severe downside in case of a recession, we think our barbell approach provides much more flexibility and optionality in the downside scenario, but also some good convexity, some good upside in the recovery scenario.
Excellent, thank you. So that just leaves me to thank Alberto for his time, and as always, thank our listeners. We hope that this has been informative and useful and look forward to revisiting the topic over the coming weeks and months. So until next time.
The Alpha Horizon. Thinking different, acting aware.